In this week's video, we'll review the latest charts to help us answer the question, will the president's positive test be followed by a bear market in stocks? We'll be reviewing 8 new hot-off-the-presses stock market studies to help us assess the probability of good things happening relative to the probability of bad things happening. In recent weeks, we've had a wide range of indecisive charts, including the QQQ-TLT chart that we covered in last week's video. On Friday, October 2nd at 2:37 p.m. Eastern Time, QQQ-TLT was up 2.79% for the week. Just before 3 p.m. Eastern Time, the S&P was still up 62 points for the week. None of the indecisive charts that we've covered in recent weeks have broken in one direction or the other in a convincing manner. Looking at this chart here, during the last hour of trading on Friday, we're trying to nail down the 7th consecutive weekly close above an area that acted as resistance 2018 and acted as resistance in late 2019, early 2020. Let's compare and contrast. Ratio firmly rejected here. Not even enough momentum here to get back to the line. Firmly rejected here. Probably fair to say at this point that this looks discernibly different from this, and this. We have indecisive charts and a long list of things to be concerned about. Nothing new relative to how we plan to handle it walking forward. We trade the chart in front of us. No assumptions as to which way this is going to break and which way it is going to hold. And in order to trade the chart in front of us in an effective manner, we have to be open to and understand a wide range of outcomes, from wildly bullish to wildly bearish. If we can do that, we can maintain the needed maximum flexibility. At some point over the past 8 months, most of us have heard the expression that we are living in unprecedented times. And many of you know, in terms of the virus, something similar has happened in the past, the 1918 flu pandemic. It was highly infectious, spreading through respiratory droplets. Cities mandated masks. Some people refused to comply or to take them seriously. Very, very similar to what we're experiencing in 2020. Here's a picture of football fans attending a collegiate game at Georgia Tech in 1918. In 1918, schools, churches, and other places of public gathering were closed. Volunteers assembled to make hundreds of masks, and businesses impacted by the shutdowns eagerly awaited for health officials to signal a return to life as usual. From a stock market perspective, there are numerous things to be concerned about in the present day, the big three being the election, the economy, and the virus. Investors are always worried about something and always bracing for something. 2020 is not unique from that perspective. Over the next few days, weeks, months, and years, it would be prudent for us to keep these basic concepts in mind. Optimism has never been cool. It's an attitude that is inherently vulnerable to scorn in a way that pessimism somehow isn't. Taking a pessimistic stance instinctively feels like a smarter, safer option. While our present-day situation feels new and unprecedented, human beings reacted in basically the same way in 1918. And there's nothing particularly new about investors worrying about a long list of concerns. And there's nothing particularly new about optimism being out of style. And once again, since we're talking about human beings, psychology, greed, and fear, there's really nothing particularly new in the stock market either. And before we cover numerous studies, it's prudent to review how technical analysis can help us. Technical analysis tracks the past. It does not predict the future. You have to use your own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. And this concept on the right side of the screen is why the concepts on the left side of the screen can be so powerful. Given that we've got plenty to worry about over the next 90 days and next 2 to 3 years, let's see what we can learn from the past actions of some traders. Study number 1. Daily chart of the S&P 500 index dated September 30th, 2020. The 133 trading day rate of change is shown on the bottom of the screen. It's been 133 trading days since the major low was made in March. A rally of this magnitude is extremely rare. If we go back to 1970, we've only seen it 3 previous times: after the major low in 1974, after the major low in 1982, and after the major low in 2009. Therefore, it might be helpful to ask and answer, how did the stock market perform following the 3 previous instances? Looking out 1 to 5 years, the answer is quite well. 100% of the cases were higher 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. And keep in mind what we're doing here. We're looking at the past activity of some traders and trying to assess what it might tell us about the future activity of other traders. In this case, the message twofold. We can maintain a longer-term focus as long as the data that we have in front of us allows. We trade the chart in front of us. We never trade historical studies. The left side of the screen helps us keep realistic expectations about 100% normal and to be expected volatility that occurs within the context of any bullish trend. Study number 2, similar situation here. We're looking at small caps, top of the screen, IWM. We have data going back to the year 2000. Extremely rare to get a magnitude like this in terms of a rally after a major low. Only happened 2 previous times, after the major low in 2009 and after the major low in calendar year 2002. This point here is similar to this point here and this point here. Thus, it might be helpful to know, how did the stock market perform in the 2003 case and the 2009 case? In the 2 historical cases, the answer is extremely well. Both cases, the stock market was higher 6 weeks later, all the way out to 5 years later. Study number 3 provides some insight into the credit markets. Think of it this way. If you knew economic Armageddon was right around the corner, would you rather own TLT, long-term treasury bonds, or higher yielding junk bonds? This is what economic fear looks like. Economic fear, economic fear. This is what increasing optimism looks like. Have data going back to 2008. We've only seen a move like this 2 previous times, 2009 and 2012. How did the S&P 500 perform walking forward? Similar story. Both cases, the stock market was higher 6 months later, 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. In order to get to the right side of the table, investors had to have realistic expectations about volatility. Study number 4. It's a weekly chart of the value line geometric index. It's an excellent way to track the performance of the average stock. It is an extremely broad index. There were broad rallies from 1980 to 1998, 2002 to 2007, 2009 to 2018, and in each case, significant declines followed. It's been 26 weeks since the major low was made in March of this year. This move is rare. Only happened 2 previous times dating back to 1980, after the major low in 2009 and after the major low in 1982. Notice the rate of change hits this dotted line here, never hits it in here, hits it again after the low in 2009, never hits it until the year 2020. Also extremely noteworthy. It's next to impossible to make the case that the average stock is currently in a bubble. The average stock has gone absolutely positively nowhere since this peak was made in 1998. This is a strong bullish trend, and this is a long-term period of consolidation and confusion. This move right here, and the fact that this index peaked in calendar year 2018 tells us this point here, right here, this point here, right here, and this point here, they really don't look like the latter stages of an out-of-control bubble. And let's look at the facts. How did the stock market perform walking forward from this point here and this point here? Was the end near? In these two cases, the answer was a definitive no. In both cases, the stock market was higher 2 months later to 5 years later. 3 years later, the average return, 42% in the S&P 500 index. Study number 5. Now we're looking at market breadth. Right here, this shows us the percent of S&P 500 stocks above their 50-day exponential moving average. This looks busy, but we'll walk through it. This is earlier in the year near the low. This is an extremely rare oversold condition. This is basically your breadth thrust off of the low, also extremely rare. Now breadth has weakened considerably, and we're all the way back down here. So this type of move from point A, the blue line, to point B, the green line, back to point C, extremely rare. Only happened 2 previous times dating back to 1999. Thus, this point here looks very, very similar to this point here and this point here. All three have a very similar A to B to C move. Was the rally over here and here from a longer term perspective? The answer was no, and in a fairly convincing manner in the 2 previous instances. April 30th, 2004 looks similar to September of 2020, and October 30th of 2009 looks similar to September of 2020, represented by this box, and this box. In these instances, there was a huge, massive rally in the rearview mirror, and then market breadth weakened considerably, and then market breadth weakened considerably. And yet, in these 2 cases, the stock market was higher in both cases 6 months later, 1 year later, 2 years later, 3 years later, and 4 years later. Average gain looking out 3 years, 35%. Study number 6, basically the exact same A to B to C type move. This time we're looking at Nasdaq, the percent of stocks above their 50-day simple moving average. This point here is very similar to this point here, and this point here. And in the 3 previous cases, the rally was not over, not even close. Stock market was higher in all 3 cases 6 months later, 1 year later, 2 years later, 3 years later, and 4 years later. Average gain 3 years out, 46% and change. Median gain 3 years out, 46% and change. Worst case scenario, a gain of 37.19%. And that's walking forward from this point here, which is similar to September of 2020. Study number 7, the average yield of the S&P 500 index. It's a weekly chart, goes all the way back to 1950. Extremely rare to see the rate of change move from the top blue line to the bottom blue line. Only happened 2 previous times in the last 70 years. This point in 2009 is similar to the present day, and this point in 1975 is similar to the present day. In the 2 previous cases, after S&P 500 yields basically collapsed, similar collapse, stocks were higher in both cases 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. To get to the right side of the table, had to endure 100% normal and to be expected volatility. Study number 8. Have data for light crude oil. Daily chart. Have the data going back all the way to 1983. A sharp rally in crude oil, a similar rally that produced a move to this point here, and this point here, as you can see, has only occurred 3 times since 1983. Never happens in here, never happens in here, and never happens in here. In the 2 previous cases, stocks were higher 2 months later, all the way out to 5 years later. Average gain 2 years later, 37.63%. Average gain 4 years later, almost 63%. All of these tables are showing the performance of the S&P 500 index. And all of them are objective. We're taking something that just happened in the present day. Taking something that just happened in the present day and looking at history to help us better understand what the past activity of some traders may say about the future activity of other traders. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.